So when assets are contributed to a corporation by a shareholder, what happens when the asset has a mortgage on it and that mortgage is being assumed by the new corporation? The exam's going to ask about the shareholder's basis in the stock of the new corporation. They'll ask about the gain, if any, to the shareholder, and the basis of the asset to the new corporation. So we'll start with something very simple. They want to know Heidi's basis in Pi Corp stock. So Heidi and Mills organized Pi Corp, which issued voting common stock with a fair value of $120,000. Each stockholder contributed property as follows. And that's good news. That means there's no services being contributed for stock, which means they're going to meet the 80% rule. Heidi contributes a building. She's the one they're asking us about. And it has a basis of $40,000, fair value of $55,000. We don't care about the fair value because as long as they meet the 80% rule, the building's just going to roll in at basis. And then Heidi's going to have that same basis in the stock. So the answer is $40,000 will be Heidi's basis in the stock. Letter B. The general rule to incorporate is that property is transferred to the corporation at the same basis that previously existed, in this case $40,000. Now there was no mortgage on Heidi's building, but what if there is? Okay, so now we're going to assume that Heidi's building had a mortgage of $10,000 and Pi Corp is going to assume the $10,000 mortgage. How's that going to affect Heidi's basis in the Pi Corp stock? Is it still going to be $40,000? Letter B? No, but it'll start out at $40,000 and then we're going to subtract from her basis the liability assumed by the corporation because Heidi got debt relief here. Heidi's being relieved of this mortgage by the corporation. So that's going to take her basis down from $40,000 down to $30,000. Heidi's basis in the stock will then be $30,000. And having that lower basis is going to be important because when she goes to sell the stock, she's going to have a potential gain because her basis is now a little lower. It's now $30,000 instead of $40,000. And you never want your basis to go down because when basis goes down, you have a potential for taxable gain. So why is her basis going down? Because she's getting rid of a mortgage. We call this debt relief. The liability being assumed by the corporation gives Heidi debt relief, and debt relief is either taxable now or taxable later. In this case, it's going to be taxable later because she still has a basis remaining in the asset being contributed. All right, similar facts. Calculate Heidi's recognized gain in the current year. Well, she didn't sell the stock. Does she have any gain in the current year? What about the fact that the asset had a basis of $40,000 when she contributed it and it's worth $55,000? Does that lead to a $15,000 gain right now? No, because they meet the 80% rule. So we don't even care about the fair market value of Heidi's building. There's not going to be any recognized gain for Heidi this year because we took her basis down by the amount of the debt relief, $10,000, and we said there's still a basis remaining of $30,000. Therefore, no recognized gain now. So Heidi's going to have a gain in the future when she sells the stock maybe because of the reduction in basis from $40,000 down to $30,000. For example, if she sells the stock next week for $33,000, she'll have a $3,000 capital gain. But if she doesn't sell the stock, her recognized gain right now would be zero because she still has a basis remaining in the asset being contributed. We took the basis down, but it went down from 40 to 30, and we said that's the basis of her stock, $30,000, and because she still has a basis left in the asset, there's no recognized gain this year. And that's exactly where I expect the exam to test you. Another likely question they could ask is, what is Pi Corp's basis in the building contributed by Heidi? So Heidi just contributed this building in exchange for stock. What's the corporation's basis now that they own the building? And that's a good question because there's a lot of possible choices here. Is it Heidi's rollover basis of $40,000? Or is it Heidi's basis in the stock, $30,000, after that $10,000 decrease in basis? Or is it the fair market value of $55,000? Or is it something else, something related to the mortgage? Well, the answer is $40,000, and there's a very important rule. The corporation's basis in the new building is the greater of the debt assumed, which is $10,000, or the transferor's basis of the asset, which was $40,000. Notice that Pi Corp's basis is not $40,000 plus the $10,000 mortgage, but $40,000 or the $10,000 mortgage. So it's the rollover basis or the mortgage being assumed, whichever is greater. In this case, the mortgage is only $10,000. The basis originally is $40,000. That's what the corporation will pick up as the basis in their new building. And notice that Pi Corp's basis in the building, $40,000, is not the same as Heidi's basis in the stock, which is $30,000. And now you see why they love to ask you questions like this. So far we looked at this and we said Heidi's building had a mortgage of only $10,000, but what if Heidi's building had a mortgage that was much higher? What if Heidi's mortgage on that building was $100,000 and the basis was only $40,000? What happens now? How much is Heidi's recognized gain? Well, when the mortgage was only $10,000, all we did was reduce the basis from 40 to 30, and we said Heidi didn't have any recognized gain. Can we say that here? Can we say that there's no recognized gain for Heidi when the mortgage is $100,000 and the basis is $40,000? No, we can't do that here. We start with the basis of $40,000 and we reduce the mortgage just like we did when it was only $10,000. But now the liability assumed by the corporation is $100,000. That brings Heidi's basis down to below zero, minus $60,000. And that's key here, that she's sitting with a minus $60,000 basis. Funny thing about basis, it's not allowed to be negative. So if the basis is negative, guess what we got to do? We got to bring it up to zero. And we do that by adding $60,000 to her basis, and that creates this gain, which is taxable to shareholder Heidi right now. So the gain taxable to Heidi, her recognized gain this year, $60,000, which is letter D. So when there's debt relief, you take away that whole mortgage and you see if it winds up being underwater like this, minus $60,000, you got to bring it up to zero, and that's going to create a recognized gain. All right, similar facts. How much is Heidi's basis in Pi Corp stock? So she's contributing the building, basis of 40, mortgage of 100,000, and she wants stock in the new corporation. She gets her stock, she gets rid of that big mortgage. How much is her basis in Pi Corp stock? Well, how do we start it? Same way, we say the basis is 40,000. We subtract the liability assumed by the corporation. She gets debt relief, right, of 100,000. That puts her underwater, minus $60,000 basis. We recognize all 60,000 as a gain to Heidi. And what does that do? That puts her basis at zero. So we did all that to bring her to a zero basis in the stock. She has no basis in Pi Corp stock, so that when she goes to sell it, it's all going to be gain. Now you may have been wondering about this. How much does Pi Corp value the building contributed by Heidi? And if you think you know, leave me the answer in the comments section below. Don't forget to like and subscribe because it helps the channel out a lot. And if you need more help in corporate tax or any part of the REG exam, go to CPAexamtutoring.com, home of the I-75 course, the #1 CPA review supplement. And of course, all videos are hosted by me, Darius Clark. So get yourself on I-75, the right road to passing the CPA exam.